In this video, we're going to be talking about margin trading. So what is margin trading? Margin trading is basically borrowing capital from your broker or an exchange to open a position larger than one would otherwise be able to. So what I'm saying here is, so in margin trading, you can trade with money that you don't actually have in your account. And this money can be as much as times 100 of what you have in your account. So for instance, let's say you're on Bybit. Bybit is a margin trading platform, right? So you're on Bybit and then you have $100. $100 is too small to make a lot of money in the market. So now you have $100, but you want to trade with $1,000. Are you getting it? You want to trade with $1,000. The broker will give you this $1,000 for sure, but you are going to be using your $100 as collateral. So you have $100, but you want to trade with times 10 of that $100, which is $1,000. That's where leverage comes in. So the leverage you'll be using is times 10 leverage, 10 times leverage, right? So the exchange is giving you times 10 of what you have in your account. So here is the tricky thing about margin trading. So now that you've borrowed, you've collected $1,000 from the exchange, you have $100 as collateral, right? So let's say the position you took is in your favor. Let's say you bought BTC worth $1,000, right? And then BTC increased 10%. That would be 10% of $1,000 that you are trading with, which is $100. So now, because this BTC that you bought with $1,000 has gone up 10%, it means you already made $100 out of this $1,000, which means you already make 100% of your money. Now, if you close that trade in profit, you have $200 in your account. Do you understand? You just made more money. You just made 2 times of your money. You just made 100% of your money by just borrowing more money in the market, right? So on the other hand, let's say the trade went against you and you lost 10% out of this $1,000. So you bought BTC around let's say you bought BTC with the $1,000, right? But the trend went against you and you lost 10% of this $1,000. Once you lose 10%, it means you've already lost the collateral amounts you gave to the broker, which is $100. So once you lose 10%, which is $100, they will close the position automatically, which is called liquidation, and they will take your collateral because that's the $100 that you've lost in this trade. Do you understand? Another example is, let's say it went against you 5%. So you bought $1,000 worth of Bitcoin, but Bitcoin dropped 5%, and you are willing to close your position. 5% of $1,000 is $50. So $50 will be removed from your account. Now you have $50 left. So you just lost half of your money. So that's how margin trading works. So that is what margin trade is all about. It's basically borrowing money that you don't have in the market to trade. So if you make money, it's good. If you lose money, it's really bad for you. Margin trading is the real type of trading because you can easily scale up with your account by borrowing, right? You have $100, you want to trade with $10,000, the exchange will give it to you. So let's say you have $100, but you want to trade with $10,000, right? It means you are trading with 100 times of your money. So by the time you are filling up your order, your leverage will be 100 times. It means you are using 100 times of your money, of the initial capital you have in your account to trade, right? Because you want to trade with $10,000. That's 100 times 100 will give you $10,000, which means you are using times 100 leverage. So it means 1% against you is $100. So 1% of $10,000 is $100. So in that case, they will liquidate the position for you. You get, they will take all your $100 in your account and then close that particular position. But if the trade went in your favor, let's say the coin you bought went up 1%, it means you just made $100. So you have $200 in your account. Are you getting it? So that's how margin trading works. That's how leverage works, and that's how liquidation works. With margin trading comes liquidation. So if you don't set your risk reward right, if you don't set your position size right, if you don't set your money management right, margin trading is not for you. You're going to lose money in margin trading, because margin trading is all about liquidation. Do you understand? If you make the wrong trade and you don't use a good stop loss, you can easily get wiped. Your whole account can be taken off. So let me now give you a type of margin trading. So we have the isolated margin. So isolated margin, let me give you an instance. So you have $100. So for isolated margin, you have $100 in your account, right? $100. But now you want to trade with $500, right? So if you want to trade with $500, normally if you are using your old account, if you are using your old $100 as collateral, all you need to fill up is ×5 leverage. That means you want to use ×5 of your money to trade, because you have $100, you want to use 500, that's ×5. So on a normal day, your leverage will be ×5, 5 times, right? But now you don't want to put all the money you have in your account on the table. You don't want to use the whole amount as collateral, right? Because if the trade liquidates, they're going to take this $100. So for this kind of trade to liquidate, for them to liquidate this kind of position, you put $100 on the table for the broker as collateral, and you're using 500. If you lose 20% of $500, then they will liquidate the account. But right now you have just $100, but you just want to take this position alone. You want to have more money on the table to take more positions later, because if you use the whole $100 for this trade alone, then you won't have any more money to take another trade, just in case you see another opportunity. And that's why you have to be using isolated margin. So it means, so let's say I want to trade with $500. I can easily use $50 out of my own account. So now you want to trade, but you want to have more money on the table just in case you see another opportunity in the market later. So you have another capital to trade. So you have $100. So out of the $100, we want to use $50 out of the $100 to trade, right? So we want to use $50 to trade with $500, right? So that will be ×10 leverage. So now we'll be using ×10 leverage. So if you use ×10 leverage, right? ×10 leverage for this particular trade, the broker is going to remove just $50 from your account as collateral, right? So you have $50 left. So they will remove $50 because 50 times 10 is $500. So you are basically using ×10 of the money you are putting on the table. So they're just going to remove $50 out of your money. So if the trade goes right, then you're cool. For every trade you take, they will show you where they're going to liquidate you, just in case the trade goes against you. So that's why you always need stop loss. Do you understand? So that's how margin trade works. And for cross margin was the one I explained at the beginning, when you use your own accounts like this $100 to take trade. You get me? So now $100, you want to take a trade of $500. So you are using your old account as collateral. If you are using your old account as collateral for a $500 trade, for them to liquidate this $100, for them to take it all from you, you have to be in a minus 20% losing trade. Do you understand? 20%, because 20% of $500 is $100. So that is cross margin. So when you use the whole amount in your trading account to take a trade as collateral to take a trade. Do you understand? Isolated margin is when you use some part of your total amount to take trade. You're using just certain percentage of the money in your account as collateral, not everything. Do you understand? And I will advise you always use isolated margin, because you are not using the total amount in your account to take trade. Another example, let's say I have $100, right? And I want to trade with $5,000, right? What leverage am I going to be using? Here, I'm going to be using leverage is 50 times leverage. So here I'm going to be using 50 times leverage. It means I have $100, but I want to trade with $5,000. That's times 50 of what I have in my account. So in this case, you type 50 times leverage and then you fill in some other things. And I'll be showing you how to do these things later in the course. So back to margin trading. I already explained liquidation in the illustration I gave previously. With margin trading comes liquidation, and liquidation is the price at which your losses are such that the exchange will forcibly close your position. Do you understand? So when you're already losing on a position and the loss is already getting to the amount that you use as collateral for collecting the money you used to take that trade, then they are going to liquidate that position. They will take the money from your account. Do you understand? So usually, very clearly on the exchange, if you are using 25 times leverage, right? If you are using 25 times leverage, a trader's position will be liquidated if you lose 4%. Do you understand? So I explained that too in the previous illustration. So for example, if I'm using 25 times leverage, and I have just $1 in my account, right? It means I'm going to be using $25 to trade. I have just $1. I'm using times 25 of my money, which is $25. So for me to lose my $1, for them to close this position, for them to liquidate me, I will have to be losing $1 inside this account, and $1 will be equivalent to what? 4%. So if 4% goes against me in this $25 trade, then they will liquidate the position, because 4% of 25 is $1, right? So I said cross margin is when you use your entire available balance to take a trade. You are using your entire account as collateral to collect money to take a particular trade. For isolated margin is when you use a fixed amount or a particular percentage of your capital as collateral to take trades. So margin simply allows you to open positions at a fraction of the cost without using your entire account balance. Do you understand? One standout positive thing about trading with leverage is that you can take a short trade, unlike regular trading where you can directly benefit from a price fall. So what this is telling us is, for margin trading, you can easily make money when market is falling. It's called a short position. I think I've mentioned this a couple of times in the course. So when you take a short position, it means if price of that particular asset or commodity drops, you will make money when you take a short position. Do you understand? So when you take a short position, if Bitcoin is dropping, you are making money. And if your position is very large, you are making a lot of money. But the only reason why you won't make money is if you take a short position and the price starts to go up, then you will lose money. Do you understand? So that's the other side of it. Do you get? So you can either make money when price is going up, and you can also make money when price is coming down. For me now, if I miss a rally, let's say Bitcoin moves from 8,000 to 10,000 overnight, I don't need to panic, because I know there will be correction and I want to make money during that correction. Do you understand? So it's a two-way thing. You can either make money when price is going up, and you can also make money when it's coming down. That's all about margin trading, and I'm going to be showing you different exchanges where you can margin trade. I'm going to be registering, and I'm going to be dropping a link below where you can register, deposit money, and start trading. I hope you guys understand what margin trading is. I hope you understand the concept of liquidation. I hope you understand the concept of leverage. This will be the end of this video. I will see you in the next.